Now, even though it recently passed on raising interest rates again, the Fed vows to continue to fight inflation. They want it down to 2%, but that last little bit, it is being stubborn. Kevin O'Leary, Shark Tank investor Kevin O'Leary, was on Fox Business recently. Here's what he said.
The idea that they'll be lowering rates anytime soon, forget about it. And top of that, either it's going to be much longer at these levels at 5.5%, or more likely in December would be a 25 basis point rate hike, which is now back on the table. I think before this is all over, if inflation stays stubborn north of 3, we'll get to a 6% terminal rate. And right now, the number one leading attribute to deciding what happens next is inflation. It just won't go away.
So I have to ask, if inflation will not go away, has this changed your outlook when it comes to managing retirement portfolios?
Chris, I don't think it's necessarily changed it. It's definitely put a laser focus on it. And, as I'm, kind of sitting in our listeners' chairs or cars, and I'm thinking, really, what's the difference between 2% and 4%? I mean, marginally, it's not a huge difference there. But when you extrapolate that out over time, the impact is really substantial. And what I'm referring to is when we go into a financial planning engagement with our clients and we're running the numbers, and as we've talked about in the past, Nolan, and our listeners may or may not know, but we run a Monte Carlo analysis. It's a fancy term for a computer simulated rendition, or 10,000 different renditions of what your possible outcome could be in this particular scenario, in your retirement scenario. And it's really mind-blowing that, we have the ability to change all the assumptions. Inflation is a big one that we run a stress test on, meaning we can adjust that inflation figure from 2 to 1 to 3 to 4. And what's really eye-opening is the fact that when you change the inflation adjustment, the input there from 2 to 4%, even 1% increase, you take it from 2 to 3, what was previously a really high probability of success, meaning we give our clients a percentage, let's say 90%, to show that, 90% of the trials in this analysis that we ran, it showed you guys as having money left over at the end of your life. When you increase it by 1%, it immediately moves the needle almost effectively to like 30, in some cases even lower. And so you wouldn't think about that intuitively, because it's only 2%, but 2% on top of 2% on top of 2% for the next 30 years really can become a problem. And so it makes sense when the Federal Reserve is been so aggressive at fighting inflation to the tune of in some cases a 500% increase in interest rates, causing a lot of the 2022 market correction. Many people feel as though that was part of the reason why we had those bank failures earlier in the year. They put a lot of effort and time and risk into, making sure that inflation is kind of subsided. And, for the most part, I think it's working. I think that the Fed has done a pretty good job of having this soft landing. But the takeaway here is that they may not have a choice. Inflation, that's just one very blunt tool. The inflation component that the Federal Reserve has, the interest rate component that they have to fight inflation. But there are other factors that can still cause inflation to run out of control. And so if you don't know exactly what the impact of even just a 1% increase on the assumptions for inflation is on your financial plan, you really do need to have somebody, take a look at it, have one of the advisors here at America's Retirement Headquarters run that inflation adjustment, run that stress test to give you an indication of, okay, what do I need to do, most importantly, to offset the risk of inflation? Because there are a lot of things that we can do. One of them I'll just briefly mention is your Social Security decision. A lot of people think about Social Security. The majority of the people think of it as just as a monthly income. But what you really are getting with Social Security is a cost of living adjustment that pretty much keeps up with, if there's any measurable inflation through the CPI, you're going to get an increase. So that's one of the ways that we can help you offset the risk of inflation, is making sure that you max out your Social Security, because it is one of the few benefits that you get a cost of living adjustment if there's any measurable inflation, and you get an 8% increase every year by waiting, and it's the most tax efficient vehicle income that we know of So that's something that we can definitely help take a look at.
And I think, again, the key takeaway there is a lot of people listening to the show have some type of financial plan put in place. Whether it's working with a financial professional, whether it's an old plan that you got from work. What we're talking about here is specifically stress testing your current plan on how inflation is going to impact it. I think actually our government has done an absolute horrible job recently with controlling the economy. And not so much the Federal Reserve, because they had to raise interest rates to combat inflation. But the problem is
they're not the ones spending.
They're not the ones spending. That's the real issue here, is the fact that, right now, even as of last month, we're spending more now on our interest debt than we do on our national defense spending. Our debt is continuing to get out of control, which means this inflation problem could be a problem that lasts a long time, because there's only so much they can do at the Federal Reserve with changing interest rates. Going back to showing you an example of John, who we spoke about in an earlier segment, what we had talked about with his $360,000, if he takes out $2,200 a month, at the age 70, using inflation at 2%, he has about an 88% probability of success of having enough money to last the rest of his lifetime, a 90% probability of success. When I go in and I change that number and I change it from 2% inflation to 4% inflation, his probability of success drops to 56%.
Yeah.
Wow.
It literally becomes a coin toss. And the challenge here is, I think most listeners have not stress tested the impact of what inflation is going to do. So what this means to me is inflation's decisions on managing portfolios, it further reinforces the fact that our strategy, called the independent income system, is a strategy that's designed to weather the long term, to address today's current environment. In fact, I know we're coming up on a break, so I would encourage you, take a minute, just Google independent income system, and you can learn more about what that system is. Or in addition to that, pick up the phone, give us a call, and let us stress test a portfolio, because it could be 10 or 15 years before the eroding impact of that inflation derails your retirement. But wouldn't you want to know now? And that's exactly what that analysis can tell you, is what it knows, and give you a chance to do something about it.
And Nolan, I think it also underscores the fact that you don't want to be too conservative, because inflation and investing in stocks kind of gives you a little bit of an insulation in many cases. Inflation dividends are, we call dividends the inflation killer. And so, you want to be invested. So if we're having these conversations about, am I too aggressive? Is the market too volatile for me? That's something to consider too, is what's the impact of inflation?
Because it's one thing to know that inflation is always going to be a factor, taxation is going to be a factor, the markets are going to fluctuate, but to figure out how it's going to work for you or against you, that is where having that stress test done, having a plan customized for you, really comes into play, and that is what the team at America's Retirement Headquarters can help you out with. All you need to do to take charge, give a call, 419-794-3030. That's 419-794-3030, or go to the website, arhq.com.